everyone, and welcome. This is Kevin with Online Trader Central. We want to welcome each and every one of you to the presentation today. We are very fortunate today to have with us our host and presenter from PTAUSA.com. Please put your hands together and welcome.
Thank you very much for that introduction, Kevin, and thanks to all of you for coming out today for this presentation. I'll try to give you some information that you'll find useful and maybe entertain you a little bit along the way. So today we're going to talk about money management for Forex in particular. And as my friend Robbie the Robot is saying there, we're going to be talking about some of the automated stop strategies featured on the Ninja Trader platform. So if you happen to be a Ninja Trader user, you're going to get extra info out of today's presentation. If you haven't tried Ninja, you might want to give it a try. It's my favorite. If you're pretty satisfied with a different platform, odds are that you can probably perform some of the same functions that we're going to talk about with your platform. So you might want to look into that if you're not using them already. Now, for those of you who don't know me already, I'm a California lawyer, and I have specialized in financial, retirement, and estate planning. I've held the following financial licenses: Series 3, which is Commodity Futures and Options; Series 7, General Securities; Series 66, Investment Advisor. I've also held a number of insurance licenses in California: life, accident, health, variable contracts. This is all part of the financial planning aspect of my career. But what I have enjoyed doing for the majority of my adult life has been trading and teaching people to trade and learning more about trading myself. I began trading in 1984, and you don't have to be a math whiz to realize that this makes 2014 my 30th anniversary as a trader. I also began mentoring other traders in stocks, futures, and Forex in 2000, so it's my 14th anniversary as a trading mentor. I have been an NFA CFTC registered commodity trading advisor since 2003. My favorite method in market is to day trade the S&P E-mini, but I also have done my share of Forex, and that's what we're here to talk about today. My favorite trading platform, as I mentioned earlier, is Ninja Trader, and my favorite broker is Trenton Kimino of Global Futures in Encino, California. And I'll tell you a little bit more about Trenton as we go along. Now, I'm also a member of LinkedIn, and that's a screen capture of my profile there. And if any of you are LinkedIn members and are not already connected with me, please send me an invitation and let's connect on this social media, because this will allow you to stay apprised of my trading and upcoming webinars and that sort of thing. My friends here at Online Trading Central, Kevin and Kathy, are connected with me on LinkedIn. So if you'd like to use that, please feel free. I also want to show you my blog on the Pacific Trading Academy website, pacifictradingacademy.com. And if you go to the blog link here on any page, there's a little short menu that drops down, and you want to go to Mentor Mike's Market Movie. And we have quite an archive here. There are movies, there are screen captures, there are essays on various trading topics, and it's all yours for free. So you can pick up a lot of valuable information right here on the Pacific Trading Academy website. Now, let's get into our topic. We're here to talk about money management in Forex. I tell my students that the course I deliver kind of breaks down into two parts. There's technical analysis and there's money management. Technical analysis has things to do with the whole process, but it's really more about getting into the trades. Money management also has things to do with the whole process, but it's more about getting out of the trades, knowing when to hold them and when to fold them, in the immortal words of Kenny Rogers. Now, let's look first at the primary exit strategies that we use as traders. There's scalping, swing trading, and something I call peeling off. Now, the scalping exit, what's that? That's where you set a profit target, and when the price reaches the target, you bail out of the trade with your entire position. Now, there's pros and cons to all of these, so let's look at the scalping pros. Scalping generally gets you out of harm's way sooner, so it's therefore less stressful than swing trading. And usually you get a higher win percentage than swing trading because markets always make more small moves than large ones. Now, there are certain aspects of trading that I refer to my students as cosmic truths of trading. This is a cosmic truth of trading, that markets make more small moves than large ones. Large moves contain small moves, but not the other way around. So you'll see that this factors into the mix a few times here. Now, there's also cons to scalping. One is that it can leave an awful lot of money on the table if you have a large trending move. You get your 1 or 2 points or whatever you're shooting for, and the market keeps on going in that direction, and you kick yourself for not having used a different strategy. The other thing about scalping is it can literally become addictive, and that's never a good thing. And lastly, it opposes the conventional wisdom of always letting profits run. And there's something to be said for that. Now, another of our basic exit strategies is what we call the swing trade exit. And this is where you hold your position in the trade until the market reverses and stops you out. The pros are that it will generally capture any large move when you're using this process. And it will usually produce a higher average win to average loss ratio than scalping. But of course, there's cons as well. It generally requires more waiting, and that means more stress than scalping. And usually there's a lower win percentage than scalping because, again, markets always make more small moves than large ones. This brings us to the peeling off exit. Now, some people refer to this strategy as scaling out. You may even know it by a different name, but I think once you hear about it, you'll recognize it. Peeling off is a hybrid strategy that mixes key elements of both scalping and swing trading, and of course we'll get into greater details in just a moment. The peeling off pros. In my humble opinion, peeling off increases the chance of a profitable trade whether the market makes a small move or a large move. It stacks more contracts on the first target since, again, markets make more small moves than large ones. And as a result, we can use peeling off to create a free trade. Now, again, we're going to talk more about free trade. Peeling off cons. Notice that I have the S of cons in parentheses. That's because, in a sense, there's really only one con to peeling off, and that is that it is a compromise. If we could magically know in advance whether the market was going to give us a small move or a large move, we could always scalp all the small moves and use swing trading for all the large moves. And in that way, we would maximize the potential of each and every trade. Well, the sad fact is that despite our best efforts and a host of good technical analysis tools, we never know for certain whether the market is going to take us on a long ride or a short ride. So we sacrifice the potential for maximum gain, which would be always scalping the small moves and always swing trading the large moves. But the trade-off is that peeling off gives us a better chance of at least a medium gain with either a small or a large move. Now, let's talk more about that free trade. A free trade is not a treaty between nations regarding economic factors like NAFTA or whatever. A free trade is a multi-contract or multi-instrument strategy where you exit a portion of the position and in so doing obtain sufficient closed profit to cover the transaction costs of the entire position. You can then ride the remainder of the position to further upside potential without the possibility of loss. And this greatly reduces the stress of trading. Now, let me give you a very simple example of a free trade. Not the sort we're going to get into today, but one that I think everybody can relate to very quickly. Let's say you're a futures trader and you're watching your favorite futures market and it looks like it's going to break out to the upside. So you buy yourself a futures contract, in other words, initiating a long trade, and you simultaneously buy an at-the-money call option. And I'm sure even if you're not an option trader, you know that a call is the implement that we use to wager on the market going up. So if the market does in fact go in our favor in this scenario, once we get to the point where the futures contract has earned enough open profit to cover the premium on the option and the transaction costs for both the futures contract and the option, we sell it. We take profit on the futures contract, but we leave the option, the call option, open. We've now paid for the trade. There's no way we can lose. There's only upside potential left. Now, that's a great place to be. And you've heard me talk about stress. Well, stress kills. And that's an old adage. Forgive me if you're hearing that phone ring. I forgot to disconnect my line, but the voicemail will pick it up real quick. The stress of trading is unhealthy for body and mind. It undermines discipline, and it makes us do fearful and greedy things. And it not only robs us of money, but it also robs us of the pleasure of playing and winning the game of trading. Now, I know for myself that it's not just about the money in trading. Sure, it's a great way to make a living, but there's also an attraction to trading that I think we all have experienced. There's something about pitting our intellect against the market and figuring out where it's going to go and getting paid for our efforts. And if we're under stress on pins and needles, wondering if our trade is going to be a winner or a loser, it's hard to enjoy that experience. So the free trade is what allows us to get out from under that feeling of stress. Now, in order to create a free trade, we got to know how much it costs us to make a trade. When I use the term transaction costs, I'm talking about everything related to the cost of trading. First of all, in every market, you're going to have a bid-ask spread. We typically buy at the asking price and we sell at the bid price. And this is something that occurs in both Forex and futures, my two favorite markets. Now, there's also broker's commissions. Now, this is something that we only have in futures. In Forex, as you probably know, there really isn't any commission. The cost of your trade is simply the bid-ask spread. But if you're a futures trader, or quite honestly, if you're the trader of any market that is exchange traded, you got broker's commissions, you got exchange fees, you might have platform fees if you're renting your platform. Usually you don't have that in Forex because most Forex brokers have at least one free platform that you can use. So these are all the elements that make up transaction costs. And at first blush, it would appear that the futures trader is at the disadvantage because he's got all these elements, or most of these elements, making up his transaction cost, whereas the Forex trader really only just has the bid-ask spread. But let's take a closer look. Cost comparison number one. This is taken from my personal experience. The cost in my S&P mini account consists of two things. First, the bid-ask spread, which most of the time is one tick. In fact, I would say about 99.9% of the time it's one tick. And one tick, as you may know, is worth $12.50. In addition, in my particular case, I have an all-inclusive commission and exchange fee package of $6 per contract. Now, you can probably do better than that if you are an individual and you open an account with a broker like Global Futures that specializes in the day trading clientele. The reason I pay what I pay is because my accounts are all corporate accounts and I'm a registered CTA, and that makes for a few more headaches for the broker than a typical client. But there's also retail brokers who charge considerably more. So in any event, this is what it costs me. So let's imagine if I trade one contract and I buy the asking price but then immediately sell at the bid price before the market has a chance to move, my total cost is going to be $18.50. So that's what I got to make in a futures trade before I can even think about earning a profit. Every trade costs me at least $18.50 per contract. All right, let's take a look at Forex. Now, the cost in my full-size Euro US dollar Forex account consists of just the bid-ask spread. But on average, in that particular market, the bid-ask spread is typically 3 pips. And again, in a full-sized account, it's $10 a pip. So the cost is $30. Again, if I trade one contract and I buy the ask and immediately sell the bid before the market moves, my total cost is $30. Now, this higher cost is one of the reasons why I prefer to trade the S&P E-mini. But as you're going to see, my technique will work very well in Forex just the same. All right, now, free trade goals. How do we set up this free trade? Well, we have to set up a logical, reachable target that, when hit, earns us enough profit to cover the entire transaction cost and a small extra cushion. And we then want our stop to automatically move to a position that protects that profit, but still keep the stop as far away as possible from the price action to minimize the chance of a premature stop out before we reach further profit. Because remember, we're peeling off part of the position, but not all of it. We got to make enough profit with that peeled off part so that we can continue with the part that remains, but there's no chance that we can lose. That's the goal. Now, I'm going to get very specific about the 3-target peel-off that I like to use. My total position consists of 9 contracts, and I divide those 9 into 3 distinct groups: 6 contracts, 2 contracts, and 1 contract. I peel off the 6, which is 2/3 of my total position, at the first target. I peel off 2 more, which is 2/3 of the 3 contracts remaining, at the second target. Now, the last contract, I can either ride to the 3rd target or I can turn it into what's called a runner, where there is no specific target. It just goes like a traditional swing trade until the market stops me out. Now, I have to calculate the amount of profit needed for the transaction cost on the entire trade and the cushion to create the stop for the part that remains in play. And that's how much I've got to achieve when I peel off those first 6 contracts at the first target. Now, let's get more specific. In the Euro US dollar, we know the transaction cost averages $30 a contract based on a 3-pip bid-ask spread. So $30 times 9 contracts equals $270 of total transaction cost. So $270 plus a cushion amount must be earned by the 6 contracts peeled off at the first target. But the number of pips in the first target must bear a logical, mathematical relationship to price movement. Measuring volatility is essentially what we're doing here. In setting the first target, we can't just pull some arbitrary number out of our subjective mental hat. The target number must be custom tailored to the market and to the time frame that we're watching and trading. In other words, the number must be a measurement of current volatility. And an ideal candidate for this job is Wells Wilder's average true range. Now, before we move to the next slide, quick word about this phrase, volatility. Any option traders out there know that volatility has multiple meanings in trading. In the world of options, it can refer to kind of a nebulous concept that we might describe as the excitement level or the anxiety level in the market. But it has a more traditional meaning, and that's what we're talking about here. When a market trends very steeply, either up or down, in a relatively short amount of time, that we would call high volatility. Lots of vertical movement on the price scale, not so much movement horizontally on the time scale. If you've got the opposite of that, where the market is kind of meandering sideways in a narrow consolidation channel where it's consuming a lot of time, but it's not making a lot of ground on the vertical price axis. That's low volatility. So how we set the target in our peeling off strategy is going to be based on the particular market's current volatility at the time. That's the idea. Now, here's a screen capture of one of my recent Forex charts on the NinjaTrader platform. And you'll notice that there's a green arrow pointing to this little red pennant here on the lower right. That is the numerical value of my average true range. And it's probably a little difficult to read what the contents of the pennant is, so here it is. It's 0.00080 or 8 pips. You know that this market is carried out typically 4 pips to the right of the decimal. So 0.0008 is 8 pips. So hold that thought for a moment. Now, it turns out that the average true range is actually kind of an oscillator, but we don't need to see the line move. All we really need is this numerical value. And this red line that looks like the zero line of my volume oscillator is actually the ATR. But it's kind of playing a dual role here as my zero line and as my ATR. Now, here's a little more detail about the average true range. The ATR requires reference to the current price bar and the previous price bar. The current price bar's true range is the longest of these 3 distances, either the current bar's own length from low to high or high to low, or the previous bar's close to the current bar's high, or the previous bar's close to the current bar's low. And then the average true range is a moving average of true ranges. So it's not just the length of the current bar. It also includes how that bar got there from the previous bar. Now here's another screen capture, and what I've done here is I've taken the ATR and I've moved it into its own panel. So you can see it in a little more detail. So you can see that the line actually fluctuates around like an oscillator, but it has an extremely narrow range, whereas my volume oscillator has a gigantic range. So if I put them in the same panel, the red ATR line also makes a very good zero line for my oscillator. As I say, we don't need to see the ATR line. All we need is this numerical value. Now, we take the 8 pips from the ATR, and what you see here are 2 of the order placement platforms used by NinjaTrader. On the far left here, we have what's called a DOM screen, D-O-M, standing for depth of market. This is something called the FX Pro, which is a specific platform for Forex traders. Because I grew up trading the S&P E-mini with the dome screen, that's the one that I prefer to use rather than this one, but this is what it looks like. And for creating your automated trade management strategies on the dome, you click this little button here and this lower apron opens up where you can plug in the necessary information for your automated trade management functions. And over here, you click this button here and you get a separate little dialog box where you can fill in this information. So under profit target, under target number 1, 8 pips. That's where the 8 comes in. Now, if you noticed other numbers on there that you have questions about, I'll clear those up for you in a bit. Now, calculating the auto break-even. This is the key to creating the free trade. Now, we've already established that in the euro-US dollar, we've got a transaction cost of $270 when we trade 9 contracts and have an average bid-ask spread of 3 pips at $10 a pip. If we peel off 6 of those 9 at an 8 pip profit target, that's 48 pips times $10 a pip, is a gross profit of 480 bucks. Out of the 480, we got to pay this 270. This leaves us with $210 to provide the stop for the remaining 3 contracts that are still in play. If we divide this 210 by 3 contracts, it's 70 bucks or 7 pips per contract. So I set the NinjaTrader auto break-even function to profit trigger 8 and the plus figure to -7. Now, this is the stop strategy dialog box on NinjaTrader, and there's actually 3 separate functions on here: the simulated stop, the auto trail, and the auto break-even. Right now we're looking at this one on top, the auto break-even. There are 2 values we have to supply. One is the profit trigger. That means the number of pips that the market has moved in our favor from our entry point. And then the second value is this so-called plus figure. Both of these are measured from our entry into the trade, which would be counted as 0. So if our profit trigger of 8 pips was hit and our plus figure was 0, what that means is the stop would move automatically from wherever it was to begin with exactly to our entry price. The fact that the plus figure is -7 means that our stop is still going to be 7 pips to the non-profit side of our entry point. Now, that might sound a little incongruous right now, but trust me, we have kind of a twofold goal here. We have to have the stop be close enough to protect enough profit to keep the trade from becoming a loser, but we also got to keep enough breathing room so we don't invite an instant stop out for the remainder of the position that's still in play. That's the part where we're hoping to make more profit. All right. Now, here's another way of looking at it. Notice I've got a numerical scale here. The 0, which is bold-faced, is the price at which we get in the trade. Here's our profit trigger at +8. And here's that -7 plus figure in the dialog box that we just looked at. There's a 15 pip spread here. And the 15 pip distance between the profit trigger at +8 and the auto break-even stop at -7 gives the market plenty of breathing room to ebb and flow without hitting the stop. But if the stop is hit, the result is a perfect break-even. We wouldn't make any on that trade, but we wouldn't lose any either. We would not have to worry about a losing trade. Now, we then use the auto trail function to start locking in profits as soon as the market moves to the next pip in our favor. First off, why would we want to use the auto trail function? Well, if you're a traditional day trader and you watch the market in real time and you never leave your post while you have a trade on and all of that, then you can actually use manual movement on the stop, or you can combine it with automatic movement and some manual movement. But there's a lot of reason why you would like to use the auto trail function. In Forex in particular, it's been my experience on numerous occasions that the market can move slower than a snail. And to try and watch a market like that is about like watching paint dry. Now, I'm in Los Angeles on the West Coast, and the way it works for me in that time zone is that in Forex, the bulk of the activity really drops off to substantially at about 12 noon my time, and it pretty much stays that way until midnight, and that's when it picks up again. The reason for that is that the international trading day, of course, begins in the Far East. And then halfway through the trading day in Asia is when Europe opens up. And so for the next half of a trading session, you've got both Europe and Asia active. So you've got 2/3 of the world market active at one time. About halfway through Europe, Asia closes, and we open up here in North America. So for the second half of the European session, the North American session is busy. So during the entire European session, they've got Asia going with them during the first half, and they've got us going with them during the second half. So when the European session ends, we've still got half of our session left, more or less, and so it's really just us here in North America at that point. And when we close, there's a bit of a hiatus before Asia opens up again, because that big old Pacific Ocean doesn't have a lot in between. And so it's really into the evening, my time, before Asia starts getting active. So from, like I say, from noon, my time, till midnight, forget it. It's not the best time to trade. But the market still moves. There's still people trading. And but the problem is that if there's nothing going on the chart, your attention's going to wander, and you're going to be tempted to leave your post just to relieve the boredom. And we might even want to place a trade when we go to bed and let it run all night. Now, a lot of you just cringe at that thought. You can't imagine doing something like that. I do it quite frequently, and the only reason I feel safe enough to do that is because of the auto trail function. Here's an example of one from not too long ago. This was on January 9th. Hit 2 targets and got stopped out in the flipping of the parabolic there. Picked up 116 pips. Now, in a full-sized account, that's about $1,160. Not too bad. Boy, I'm just a popular guy here. Sorry about that phone. Let's look at another one here. This is another one from the 20th of January. 111 pips, and again, this was literally a set it and forget it. The auto trail took care of getting me out of the trade all by itself. Never paid any attention to it until the next morning when I saw that I had made a profit. Now, how exactly does the auto trail work? Well, you'll remember in our last diagram here, we had our initial stop trigger here at +8, and our stop was at -7. Now, as soon as the market moves one more pip in our favor to +9, that's where the auto trail kicks in, and it maintains that 15 pip distance between the price's maximum reach into profit territory and the auto stop. So when we go from +8 to +9, our stop goes from -7 to -6. And it's set in such a way so that we maintain this interval. So the price has a lot of fluctuation here, but that's what you got to do if you're gonna be in it for the long haul. You know there's going to be pullbacks. Markets don't move in one direction for very long. There's always pullbacks in every uptrend and corrective bounces in every downtrend. So if you want to catch the maximum, you got to be prepared for that. Now, with this setting, with the auto trail, every additional pip that the market moves into profit territory is instantly protected and becomes another pip safely in my account, while still keeping a reasonable breathing room interval. So for the auto trail function, the settings are stop loss 15, frequency 1, profit trigger 9. So again, here is the dialog box. This time we're using this center function. Now, I should point out that we got 3 radio buttons here. So you can actually have 3 different layers of auto trail. You could start with a 15 pip interval, and then at some future trigger you could shorten it to an 8 pip interval or whatever you wanted to do. I haven't found that degree of detail necessary. I maintain just the one level with the 15 pip interval. So here's my first profit trigger at 8. Once it's hit, the stop moves to -7. Now that's measured from the 0 mark. When I have the market go one more tick in my favor to now 9, the stop moves 15 pips back from this 9. Not from 0, but from 9. And then the frequency set to 1 means that every time this number increases by 1, this one will maintain that same interval. So it'll go from -6 to -5 to -4, etc. Now, it seems every time I do a discussion of these automated trade management functions, I always get a question regarding the stop loss shown over here. You can see we've got the total order is 9 contracts, divided 6 on the first target, 2 on the second target, 1 on the third target. Down here, under profit target, we've got the 8, 21, and 55. These are the number of pips for the target. Then people see this stop loss at 55 and they go, "Oh my God, you must be crazy. I could never have a stop at 55." Well, I don't want to get too distracted here, too into something that's not really on point, but since I know someone is going to ask about it, let me just tell you. I don't use a 55 pip stop either most of the time. But what I do want to make sure is that the stop is safely out of the way when I first take the trade. And then once the trade is taken and I see where everything is, I can then manually move the stop to a more effective location. It's always the case that our profit targets will be measured from where we enter the trade. But not necessarily the same situation for the stop. We want to set our stops more based on what I call the topography of the chart. So if we were getting short here, at this point here, for example, where would be a good place for the stop? Well, the answer is probably a pip or two above this last high. But how do we program that into this ATM strategy in advance? The answer is you can't really. So I put a large number, a large Fibonacci number for the initial stop loss. That's going to put the stop up here somewhere. And then once the trade is actually on, I grab the stop and I move it down to where it really needs to be. So that's why that number is as big as it is. It's not because that's where the stop is going to stay. So hopefully no one is going to still ask me that question, but that's the answer to it. Okay, so let's move on. Now, if you are watching the market and you're watching it in real time, you've got another choice, which is to use the parabolic SAR. Now, the parabolic SAR happens to be another indicator from the fertile mind of Wells Wilder, the same guy who gave us the average true range. Both of those indicators were revealed to the trading world in his 1978 book, New Concepts in Technical Trading Systems. So I'll show you how this works in just a second. But the idea is that if you're watching the market in real time, you can still use the auto trail function, but there may be times when you want to manually move the stop, but you still need some guidance as to where to put it. And that's where the parabolic SAR comes in. So you can trail the stop with NinjaTrader's auto trail function, or you can manually trail it with the faster of the two parabolic SARs. You're going to see that in just a second. See, we have this large red one, and then we have the smaller, faster white one. Now I'll get back to that in just a moment. So we can trade it. We can manually keep the stop even with the faster of the two parabolic SARs. When the market rallies or sells off, that's when the auto trail kicks in. As long as the market is moving deeper into profit territory, the stop is going to keep moving as well. But when the market consolidates sideways or pulls back or correctively bounces, the auto trail is going to stop moving. However, the parabolic SAR continues to move because it moves not only from price movement but also from the passage of time. So what happens is when the market consolidates, the parabolic SAR tends to catch up and pass the auto stop. And when that happens, I manually trail the stop to keep pace with the parabolic. So the main idea here is to always use whichever is closest to the current price action. And I'll show you what I mean. Now, this happens to be Friday, January the 17th, and we're in the second of two very profitable short trades. Notice that the price is dropping substantially. Here's our first target, and we're on our way, or no, actually we've hit 2 targets. Here's the first target. Here's the second target, and we're on our way to the third target. Here's the price, the blue pennant, the navy blue. And here is where the stop is right now. It's been dragged there. We can see it's well into profit territory because here's our entry point way up here. But now look that the stop, the auto trail stop, is closer to the price than the white parabolic. The white pennant here shows us the relative value on the price scale of this white parabolic, which is the faster of the 2 parabolic SARs. Now, notice what happens in this series of slides. Right now, the price is dropping rather substantially, and you can see daylight between the white pennant of the parabolic and the gold pennant of the stop. Check out the next slide. All right, notice the price has stopped moving and is starting to make a little correction upward. The stop is in the same position it was in the previous slide, but the parabolic is still moving down. And notice that the white pennant is starting to disappear behind the gold pennant of the stop. Now, this continues a little bit further. Now, the market has continued to, after its correction upward, it's actually kind of gone into a little sideways consolidation. So again, the stop has not moved from its original position 2 slides ago, but the parabolic has continued to move closer. And now you can see that the white pennant is actually starting to emerge on the underside of our gold pennant. So when that starts to happen, that's when I switch from the auto trail to the manual stop, and I literally grab this thing by its little handle here, and I drag it down until my golden pennant is contiguous with the white pennant. And I couldn't quite capture that, but you can't see where the mouse would have been, but that's what's going on here. I managed to drag the stop down, and then when I click on it, the platform will cancel my old stop and send out a new stop order at the new location. So that's how you manually move the stop. And so you have that choice. But it only comes into play if you're watching it in real time. If you need to leave your post, as I sometimes do, I'm perfectly okay with allowing the auto trail to take over for me. Now, here's that same chart, but here's a little bit later. The price continued to climb, and it flipped the white parabolic, and I got long at that point. There was a number of other factors here which convinced me that there was a high probability that this move had reached its bottom and that the market was going to take up. Now, this happened to be a Friday, as I think I said, which means that the market is going to close here at this red line, which is 2 p.m. Pacific time, 5 p.m. Eastern time, and I don't want to carry my position over the weekend. It's not critical if I do, but the problem is that things can happen in other parts of the world, and there could be a huge gap in the wrong direction. So I just sleep better over the weekend if I don't have an open position, and so I got out right at the end of the trading day. However, I wasn't there to do it myself. As soon as I took this long trade, I went to lunch with friends, and I got out of this trade automatically, again, thanks to the NinjaTrader platform. How did I do it this time? Well, they have another very cool function. This is the so-called control center screen. You go to, I think it's the Tools menu, and Options, and you get this dialog box, and under Miscellaneous, I call this the time stop. They call it flatten positions. As I said, the market closes for the weekend. Well, it closes every day. Well, I shouldn't say it closes. It marks the change from one trading day to the next, is what I should say, at 2 p.m. But on Friday, it closes for the weekend. So notice what I did. I checked this box to flatten all at 1:59 p.m. Now, during the week, it doesn't matter if I hold the trade over. So if I've got a good trade in progress, I have this box unchecked. But on Fridays, I always check it because I want to get out of the trade automatically, and that's what I did. So I was able to take that final trade and go have lunch. Pretty cool. I would venture to guess that other platforms have a similar feature. If you're not familiar with your platform, you need to check it out and find it. Now, here's some miscellaneous Forex trades of mine over the last few days. This is from the 23rd of January, which is the day after the last time I gave this particular presentation. 233 pips. This is another auto trail trade. I took it right at the close of the day session, and I actually didn't hit my target until about midnight. And I found it shortly thereafter when I got stopped out. 39 pips doesn't sound like much, but in a full-sized account, that's $390 that I just made with absolutely no effort on my part. Here's a couple trades from the 30th of January, another 148 pips. Here's the 31st, last Friday, 215 pips. This is one trade on this past Monday, the 3rd of February, 99 pips. Here's yesterday, February 4th, 3 trades, 114 pips. There was a beautiful change of direction here, and another good trade here. I wasn't around to see this one. I was stopped out. But this trade was strictly automated. I was watching for these first two, then I took this trade and had to go do something else, and when I was stopped out, I was not in a position to reverse and go long. If I had been actually on the scene, I clearly would have, because you can see that from a technical standpoint, it looked like that market wanted to go up, but such is life. And this was from earlier today. So while I was simultaneously rehearsing for today's presentation, I was trading the Euro-US dollar, and I picked up 105 pips on these 3 trades. And I ended this one manually because I had to do some other things, and I also wanted to include this chart in today's presentation. So I'm not sure what happened here. I haven't had the chance to look and see if it will continue to go up or not. But 105 pips is not bad. In full-sized account, that's over $1,000. Notice also on this one I was experimenting with stochastics as opposed to my beloved MACD. But same good outcome, basically. Now, I promised you that I was going to tell you more about my favorite broker, Trenton Kimino. He works at Global Futures, and Global Futures, along with just about every other futures brokerage in the U.S., also does Forex trading. You can see Forex right here. Now, as you might think, at Pacific Trading Academy, we've been in business for a long time, and our job is to create successful, independent, self-directed traders. Our students, our graduates, are the exact type of client that brokers want. Brokers don't want clients who are going to go broke. Clients who go broke don't make much money for their brokers. The ones who make money are the active, successful traders who trade a lot and trade every day and make a lot of money. That's who they want. So, as you might expect, we get approached by a lot of brokers who want us to refer our students to their offices. Well, it just so happens that I've had my personal accounts at Global for a number of years. And the reason I recommend them is that they have always given me excellent customer service, and they have pledged to do the same to any students that I refer to them. And I have done that for a number of years, and I have never had a single complaint come back to me from any of my students. I have only heard good things about Global Futures. So if you are a futures trader or a Forex trader and you don't have a broker, by all means talk to these folks. If you're not completely satisfied with the broker that you have, talk to them as well. And if you want more specifics, this is the man you want to talk to. Trenton Kimino is my personal broker, and this is his contact information. He's a futures and Forex broker. You can reach him at trent@globalfutures.com. And we've got the toll-free number there and the direct numbers in the 818 area code. He is physically located in Encino, California. The clearing firms that they deal with are all over the place. Most of the futures are in Chicago, which is where all the most of the big FCMs are, and they have multiple counterparties with their Forex trading. So give Trenton a call and tell him that you were referred by mentor Mike Bridges at Pacific Trading Academy. He will definitely take good care of you. Now, I also want to go into a little bit of a self-promotion here very quickly. Hopefully some of you folks might be thinking about working with me as a mentor, and you're a little bit curious as to how we proceed with such things at Pacific Trading Academy. I'm actually in the process of writing an e-manual, Mentor Mike Bridges' Make Money in the Market e-manual. I call it 30 plus years of trading experience in 100 plus pages. I don't know how many pages it's actually going to be, but that title sounded good. And this is going to be kind of a written version of the course that I teach to my students from Pacific Trading Academy. So let me just run through this outline, and you'll see some of the stuff that we talk about. First of all, people are confused about the difference between investing and trading. I think it's important for everybody to understand that. Also, trading versus gambling. To be honest with you, there are not that many differences there. What about risk capital? What is it, and why do we need it? What markets are there for us to trade? Well, there's a few, and what you're going to find is that they are much more similar than they are different. What is this thing known as fractal geometry, and why is that important? And what about the double-edged sword of leverage? Why is it important to anybody who wants to trade? What are some of the differences between day, real-time trading versus position trading? I talk about my favorite market and method, and why that is. I have some very specific reasons why I like the things I like and don't care as much for the ones I don't care for. And we'll talk some more about various cosmic truths of trading, those few irrefutable facts of trading that no one can really deny. The next section of the outline is the basic skill set. Part 1, getting in the trade. It's all about predicting price movement. What's the difference really between fundamentals and technicals? Indicators act as reference points and filters. What do I mean by that? The primary signals that we look for are crossovers and divergence. What are those and why are they important? And I talk about various turning point theories, things like Elliott wave, the delta phenomena. Is there any truth to this stuff, and how can we use it without overwhelming ourselves? Then I get into the specifics of my proprietary trading method that I call POV, which stands for Price, Oscillator, and Volume. There's a trend-defining moving average, aka the trend definer. There's a directional moving average. There's the MACD, that's our main oscillator, and then there's volume. How do we use volume? What is volume exactly? Well, it's different things in different markets, actually. Then we come to the basic skill set, part 2, getting out of the trade. This is all about minimizing risk, maximizing profit, and managing emotions. Let profits run and cut losses short is the old adage that we try to put into practical effect. Now, a lot of these topics we talked about just now. Scalping, swing trading, peeling off, stress kills, creating a free trade, setting targets, trailing stops. Here's a couple we didn't get to today. Growing the account and finding your comfort zone. And then last but not least, we've got some miscellaneous trading issues that I get into. Selecting a platform, choosing a broker. Know thyself. What do I mean there? Well, I'm kind of a fan of neuro-linguistic programming, or NLP. It's a great way to kind of understand how we communicate with ourselves and how we communicate with others, how we view ourselves and the world at large, how we differentiate between things. Do we zero in on similarities, or do we zero in on differences? Are we motivated by moving towards pleasure and reward, or are we more motivated by escaping from pain and punishment? If you understand a little bit more about what motivates you, it can affect how you look at yourself as a trader. Here's something that some of you might be able to relate to. Trader-spouse relations. if you're an avid trader, as I have been for these 30 years, you know that spouses can sometimes be incredibly supportive and at other times a good deal less so. I'll give you some of my personal experiences in dealing with that particular aspect of the work-life balance that we have to contend with as traders. And again, staying in balance, meaning work-life balance, is something that everybody needs to do, and traders are no different. You got to watch out for your health. You've got to maintain your relationships. You've got to take care of other aspects of who you are as a person besides being a trader. And then a little something I call quantum weirdness. This includes things like HARV, which is an acronym that stands for Hybrid Associative Remote Viewing. I actually took a class once upon a time in remote viewing, specifically with regard to determining in advance the primary direction of major markets. It's very interesting stuff. Whether it works or not is certainly debatable, but the more I learn about quantum physics on shows like Sci-Fi Science and Morgan Freeman's Beyond the Wormhole, the more I think there might be something to some of these things. So these are some of the things that I talk about with my students, and this is sort of the basic skill set, you might say. And then after this, after we get this under their belt, then we look into exactly what they want to do. If they want to do stocks, futures, Forex, other derivatives of any of the above, that's when we get into that. But everybody needs to know the basics first, because in my humble opinion, markets are more alike than they are different. And time frames are more alike than they are different because of that fractal geometry that I pointed out a few moments ago. So since the markets are so similar, if you can master the basic skill set, you can really trade anything, and you can trade it on any time frame. So you got to get the basic skill set down before you start specializing in something more particular. So these are the things that I deal with in my course. If any of that sounds good, give it a thought. And if nothing else, I'll let you know when this ebook is ready for download, and you can take a look at it. Now, also, a quick announcement. For some of you may know that I had an S&P E-mini trading room about a year ago. I had to take a break for some health reasons that are now resolved. And I am probably going to be reopening it at the end of summer, just after Labor Day or sooner, hopefully. Might abbreviate the hours a little bit from what I had before, might take more time off. But the thing that's important here is it's only going to be open to current and former students of Pacific Trading Academy. It's not going to be open to the general public. But the good news is this is going to allow us to be totally unrestricted in our discussion of techniques and parameters and strategies. So it's not going to be just about somebody parroting my trade to make a few bucks. It's going to be for the people who genuinely want to learn how to do this so that they can ultimately do it on their own when I'm dead and gone. Now, we're going to spruce it up a bit. Students will be able to communicate verbally and audibly, not just through written chat, so that's going to make it a lot nicer. I was contemplating joining the World Cup Championship next year in 2015 and doing my competitive trading in the trading room, so I could kind of have the help and support of my students with me. Doesn't look like they're going to let me do that right now, but that issue is still kind of under debate. So that might be something fun if you're around at that time. Now, I think in the promo materials for this presentation, I told you guys that I would be happy to send you a copy of the chart template that you saw me using here, my Forex POV combo. It's only going to be good for you Ninja Trader people, but if you'd like a copy, or if you'd like to receive notice of when my Make Money in the Market e-manual is available for download, or if you want to be notified when my live trading room is ready to open, or if you just have other additional questions or comments, please send me an email to mentormike@sbcglobal.net, And please be so kind as to include your phone number and time zone, so that I don't call you in the middle of the night or whatever. But I'll be happy to answer any questions. Let me know if you're interested in that trading room, because it's one contingency is still having enough people interested. So if you think you might want to participate, there's no obligation, but let me know. And then, if you'd like more information about working with me on a one-on-one basis, call my good friends at Pacific Trading Academy. There's the toll-free number, 800-339-8588. And I am done at this point. Our hour is up. Kevin, I turn it back over to you, and I thank you all for your kind attention. And Kevin, special thanks to you for inviting me back to Online Trader Central. I hope to see you all again real soon. Thanks a lot.
Thank you, everyone, so much for your time and your participation here today. It's exactly 5:30. Thank you, Mr. Bridges. We are out of here, but we do want to wish each and every one of you a great day trading tomorrow, and a special round of applause for, again, each and every one of you and our host presenter, Mike Bridges. Bye for now.